Most people think a $5,000 credit limit is a safety net. They believe it's a cap to prevent them from overspending, a guardrail to keep them out of debt. But here's the truth that the credit bureaus don't want you to know. That low limit is silently destroying your credit score, costing you thousands in higher interest rates, and keeping you trapped in a cycle of high utilization and low trust. In fact, the single biggest factor in your credit score after payment history is something called your credit utilization ratio, and with a $5,000 limit, you're probably already over the danger zone without even realizing it. Your credit utilization is simply your credit card balance divided by your limit. With a $5,000 limit, a routine grocery bill of $800 puts you at 16% utilization. That's fine. But if you ever have an emergency, a car repair, a medical bill, a last-minute flight, and you charge $1,500, you're now at 30% utilization. That's the point at which your credit score starts to drop. $20,500 means 50% utilization, which is enough to tank your score by 50 points or more. L6, L9. Here's the formula. Balance U credit limit credit utilization ratio 4LE3 L24. Credit utilization makes up roughly 30% of your FICO score. It's the second most important factor behind payment history, L35, L37, L22, L24. FICO and Vantage score both consider utilization highly influential. If you have a low limit, you are constantly walking a tightrope. Every purchase pushes your ratio up, and your score goes down. Skip? Let me prove it with a real story. A viewer named Maria had a credit limit of $5,000. She paid her bills on time, never carried a balance, and thought she was doing everything right. Then her credit score dropped 40 points for no apparent reason. She was confused. We looked at her statement. Her balance was reported to the credit bureaus on her statement closing date, not her payment due date. And on that day, she had a balance of $2,500 from a recent vacation. That's 50% utilization. Her score dropped immediately 9L41, L44. She hadn't missed a payment. She hadn't applied for new credit. The only thing that changed was her utilization ratio. The worst part? She paid the entire balance off the next week, but the damage was already done. The credit bureaus only see the snapshot from that one day each month. That's the trap of a low limit. Skip, for every $1,000 of credit limit you're denied, you're likely paying thousands more in interest over your lifetime. The average credit card interest rate in 2026 is over 22%. The average car loan rate for someone with a good credit score is about 6%. For someone with a fair score, it can be 10% or more. On a $30,000 car loan over 5 years, that's a difference of over $3,000 in interest. On a $300,000 mortgage, the difference between a good and fair credit score can be over $50,000 in interest over the life of the loan. That's not a credit limit, that's a lifetime tax on your credit score. Skip Equifax data shows that total bank card limits in the U.S. reached $5.1 trillion in 2026, up 6.2% year over year. Average utilization was 20.6%, down 8%, 19 L24, L25. The median credit limit among large bank accounts is around $3,500 to $5,003, L43, L45. For borrowers with credit scores below 60, the median original credit limit at origination is even lower, and subprime borrowers start with limits as low as $703, L15, L26. Those low starting limits create a self-perpetuating cycle. Low limit leads to high utilization, leads to a low score, leads to denial of credit limit increases. It's a trap designed to keep you on the sidelines. Skip, a low credit limit is not just an inconvenience. It's a structural barrier to financial health. Here's why. First, it makes every purchase riskier for your score. One unexpected expense can push you over 30% utilization. Second, it hurts your credit mix and available credit, two factors that account for 10% and 30% of your FICO score respectively, 10L22, L24, 1L24, L26. If you have to close an old card, that lowers your available credit and your average account age, two effects that can cause your score to drop for no apparent reason, 8L23. Third, a low limit sends a signal to other lenders that you're a higher risk. When you apply for a mortgage, the underwriter sees your $5,000 limit and low credit score, and they assume you're overextended. You want to get your credit utilization under 10% if possible. That's the ideal range for a top-tier credit score, 10L27, L28, Wall 10, L31, L33. If you have a $5,000 limit, that means you cannot carry more than $500 at any time. That's a single grocery trip and a tank of gas. It's unrealistic. With a $20,000 limit, 10% is $2. Zuzen, still tight, but much more manageable. The goal is to have enough available credit that your normal spending never exceeds 10% of your limit. That's why you need to raise your limits, not to spend more, but to protect your score from your normal spending. Asterisk, skip. Most banks will automatically increase your limit after 6 to 12 months of on-time payments. But don't wait for that. You can request an increase proactively, and you should. The best time to ask is at least 6 months after getting your card, right after a raise or new job, when your income has increased and your credit score has improved. 16 L41, L47. If you've been using your card regularly and paying it off in full each month, banks see you as a responsible borrower and are more likely to approve an increase. 13 L36, L39. Asterisk, skip. Here's the script I've used successfully. Call the number on the back of your card. When the representative answers, say, "Hello, I've been a customer for X months, years, and have always made my payments on time. My income has increased by Y% since I got this card, and I'd like to request a credit limit increase to improve my utilization ratio and build my credit score. Can you help me with that?" 16 L58, L64. That's it. You're showing responsibility, growth, and a legitimate reason. Banks love that. "My income increased 15% since I got this card" is far more persuasive than "I need more credit for expenses." Asterisk, skip. Most credit card issuers allow you to request an increase through their online portal or mobile app. Look for an option labeled Request Credit Limit Increase or Manage Credit Line 21L41, L49. Some banks offer instant approvals, others take a few days. You can also call customer service directly. The representative can often approve you on the spot. 17A, L30, L46. The key is to have your current income, housing expenses, and desired limit ready. If you're denied, ask why. Often it's because your utilization is too high. Pay down your balances and try again in 3 to 6 months. Skip. Now, a word of caution. Some credit card issuers perform a hard credit check when you request a credit limit increase. A hard check can temporarily lower your score by a few points for up to 12 months. 21 L45, L47. If you're planning to apply for a mortgage in the next 6 months, you might want to hold off. Most banks, however, use only a soft check or no check at all. You can ask the representative before they proceed, "Will this request require a hard inquiry?" If the answer is yes, you can decide whether the temporary hit is worth the long-term benefit of a higher limit. Usually it is. Skip. Once you have a higher limit, your utilization ratio drops automatically. That gives you a credit score boost. A higher score makes it easier to get approved for new cards with even higher limits. This is a virtuous cycle, exactly the opposite of the low limit trap. The goal is to build your total available credit over time until your normal monthly spending is a tiny fraction of your limit. That's how you achieve an elite credit score. Let me show you a real example. A client named James had a total available credit of $8,000 across 2 cards. His monthly spending was about $2,000. His utilization was 25%, okay, but not great. His credit score was 720. We helped him request increases on both cards, raising his total available credit to $15,000. His monthly spending stayed the same. His utilization dropped to 13%. Within 60 days, his credit score increased to 760. That's the difference between good credit and excellent credit. And it happened because he raised his limits, not because he changed his spending. Asterisks. Skip. Apply for a new credit card account. If you've had your current card for over a year and your credit score has improved, you may qualify for a card with a higher limit. This adds to your total available credit and lowers your overall utilization. Just be mindful of hard inquiries. 1 new application is fine. 5 in a short period is not. Space them out. Asterisk skip. If you have a secured credit card, you can increase your limit by adding to your security deposit. Your credit limit is usually equal to your deposit amount. This is a great way to build credit from scratch. After 6 to 12 months of on-time payments, you can ask to be upgraded to an unsecured card, and your deposit will be refunded 21 L57, L63, L5, L14. Skip before you request an increase. Make sure your other credit factors are in good shape. Payment history is 35% of your score, 11 L24, L25. Miss a payment by 30 days, and your score can drop 100 points, 8 L-teen, L-17. Derogatory marks stay on your record for 7 years. Keep all your accounts current. Length of credit history accounts for 15% of your score, 8 LL1, L22. Keep your oldest accounts open, even if you don't use them. The age of your accounts matters. Skip. I cannot stress this enough. A higher credit limit is not permission to spend more. The goal of raising your limit is to lower your utilization, not to max out your card. If you get a higher limit and then increase your spending to match, you haven't helped yourself at all. You'll be right back where you started. High utilization, low score, trapped. The key is to keep your spending exactly the same while your limit goes up. That's how you win. Asterisk. James's credit score jumped 40 points in 2 months because his utilization dropped from 25% to 13%. He didn't change his spending. He didn't get a raise. He just fixed a mathematical ratio by increasing the denominator. That's the power of available credit. That's why the $5,000 limit trap is so dangerous. It keeps the denominator small, so every dollar you spend has an outsized impact on your score. Skip. Some people worry that a higher credit limit could tempt them to overspend. That's a valid concern. If you struggle with impulse control, raising your limit might be counterproductive. You need to be honest with yourself about your own behavior. There's no shame in keeping your limits low if that's what keeps you out of debt. But for the vast majority of people who pay their bills on time and never carry a balance, a higher limit is nothing but beneficial.
Skip. One final danger.
Credit card companies can lower your limit without warning. During economic downturns, issuers reduce risk by slashing limits on accounts, even those in good standing 7L38, L42. This can happen in good times too. If your limit gets cut, your utilization ratio spikes overnight and your score drops with it. The best defense is to have multiple cards with multiple issuers. That way, if one card reduces your limit, your overall available credit doesn't take as big a hit. Asterisk skip. Having multiple cards also improves your credit mix, which accounts for 10% of your score 8L23L24. Lenders like to see that you can manage different types of credit cards, loans, mortgages. But don't go overboard. 3 to 5 cards is plenty for most people. More than that can be hard to manage and may lower your average account age. Skip the $5,000 credit limit trap is a real and present danger for millions of Americans. But it's also one of the easiest traps to escape. By raising your limits, you lower your utilization, boost your score, and open the door to better interest rates and higher future limits. It's a virtuous cycle that starts with a single phone call or a few clicks online. You can break the cycle today. Skip, your credit limit is not a reflection of your worth. It's a business decision based on a few data points. Don't take it personally, but don't accept it passively either. You have the power to change it. Use that power. Your wallet will thank you. Asterisk skip. Here's your action plan for the next 24 hours. First, log into your credit card accounts and check your current limits. Second, calculate your utilization ratio for each card. Divide your balance by your limit. If any card is above 30%, you have a problem. Third, request a credit limit increase on each card where you've had the account for at least 6 months and have made all payments on time. Use the phone script I gave you. Fourth, if you're denied, ask why. Pay down your balances and try again in 3 months. Fifth, apply for a new credit card if your score has improved. Sixth, set up autopay for the full statement balance on all your cards. Seventh, commit to never carrying a balance. Interest charges will wipe out any benefit of a higher limit. Eighth, comment below. I raised my credit limit today, and tell me by how much. I'll reply to the first 100 comments. Skip. If this video saved you from years of low limits and high interest, hit the like button. It helps others escape the trap. Subscribe and turn on notifications. In the next video, I'm going to reveal why you need a wealth journal, the one habit that separates millionaires from everyone else. Asterisk skip. Your low credit limit is not a fact of life. It's a choice you make every day by not asking for more. The banks are hoping you won't ask. Now you know better. Go make the call. Asterisk skip. I'll see you in the next video.